Later.
So welcome everyone to the Microstructure Exchange. We're waiting for a minute or two until everyone has gotten into the meeting, and then we'll start. Okay, welcome everyone to the Microstructure Exchange. My name is Björn Hagströmer. I'm the moderator today, and the speaker is Evangelos Benos, who is at Nottingham University. Evangelos will talk to us about the cost of clearing fragmentation, and he has three co-authors: Wenqian Huang from BIS, Albert Menkveld at the VU Amsterdam, and Michalis Vasios, who is now at ESMA. Before we dive into it, let me tell you briefly about the format, though most of you know it by now. Evangelos has 45 minutes for the talk, and during that talk there will be a couple of question breaks. So you are all encouraged to type your questions in the Q&A function, and I will then relay those questions to Evangelos during the question breaks. And the co-authors are also active in the chat to answer some of the questions. And then after the 45 minutes, we have 15 minutes or so for voice questions. So then we will activate the raise hand function, and you can ask your questions in voice. And Evangelos has promised to stay on as long as the questions continue. So there's no need to hold back with questions there. That's all about the format. The pandemic goes on, and so does the Microstructure Exchange. We are in our second wave, and we're preparing for the third wave now. We have received a nice batch of papers to be considered for presentation after New Year's, and the emails to all the reviewers who help us with this process will go out very soon. They haven't gone out yet, so look for them in your mailboxes if you're one of our numerous reviewers. And thanks to everyone for submitting your work to the exchange and for serving as reviewers. So that's all. I leave the screen to Evangelos.
Thank you very much, Björn, and thanks for the invitation to present this paper. I just wanted to point out that some of us have been or are currently affiliated with some policy institutions, so the usual disclaimer applies. So let's dive right in, and let me just start by saying that what is going to drive the results of the paper and the effect that we're studying is multilateral netting that's associated with centralized clearing. And we have a graphic here that basically shows how multilateral netting works. And the key point to take from this graphic is that when you have centralized clearing, it is possible for the exposures that arise between financial institutions to be netted multilaterally because the clearinghouse or CCP novates these trades, novates these exposures, and acts as a buyer to every seller and as a seller to every buyer. And as a result of this novation and multilateral netting, the overall exposures in a centralized clearing, in a centrally cleared environment are reduced. And that's what this graphic shows. Now, the reason why this is important is because alongside with the exposures, what also drops is the cost to collateralize against these exposures. So exposures need to be collateralized when there's no CCP. This collateralization happens on a bilateral basis. But when overall exposures are reduced, then the amount of collateral that needs to be pledged against these exposures is reduced. And that's going to be one of the key drivers of the effects that we're studying in this paper. So that's to set the stage with respect to centralized clearing and netting. What we're studying in the paper, however, is OTC trading, and in particular, OTC interest rate swap trading. And I have this graphic here to just again illustrate that this is an OTC market, and you have dealers who provide liquidity on a global scale. Emphasis here on the word global. So you can see, for example, you may have a dealer providing liquidity in fixed rate, interest rate swaps, and there may be clients in the EU, in Europe. There may be clients in the United States. As an intermediary of these trades, the dealer generally has a balanced position. And in the theoretical scenario where you just have one clearinghouse that's novating these trades by the dealer, what happens is that everybody takes their trades and clears them with this one single CCP. And because of multilateral netting that we just mentioned, and the fact that dealers' exposures are generally matched, dealers' positions are generally balanced, the overall collateral cost that the dealer has to bear vis-a-vis the CCP is minimal. And that's largely because, as we just said, that the exposures themselves are minimal because they're multilaterally netted via the CCP. So that's what the case would be in an ideal scenario where you just have one CCP novating all trades. In reality, however, things are different. And in this particular case of the US dollar denominated swap, you may have contracts being cleared in the United States at CME and in London at LCH. And this is what a fragmented clearing landscape looks like. So in that case, as you can easily see from the graphic, what happens is that clients on both sides of the Atlantic are still doing business with the same dealer, but the trades are now cleared locally. And this can happen for various reasons. It could be the case that clients don't have the expertise or the capability to clear trades overseas. They may not have sufficient presence overseas so as to clear trades elsewhere outside of their own jurisdiction. Or there could be legal constraints as to why they cannot clear trades elsewhere. So the point is that to the extent that clients are constrained to their own jurisdiction, and to the extent that you have multiple clearinghouses clearing these contracts, what's going to happen is the dealers are not going to be able to multilaterally net these exposures with respect to the clearinghouses. Instead, dealers are going to have directional positions and exposures with each of the clearinghouses. And as a result, each of these exposures is going to attract collateral. So the collateral cost for dealers is going to go up in the presence in a fragmented clearing landscape. So this is just intended to set the stage of what this paper is about and what we're studying. So in terms of what we do is we first characterize the economics of this fragmented clearing landscape. And as we just said, and as is kind of obvious from these charts, what happens in this situation is that collateral costs go up. But what is less obvious is that these collateral costs can also lead to economically significant price distortions in these underlying markets. And in particular, we'll see that these price distortions take the form of a price differential or a basis. We call it a CCP basis, when you have the exact same contract being cleared in multiple CCPs and in multiple jurisdictions. So we provide a model to rationalize this existence of these price deviations, and then we take the model to the data to validate the predictions. The data comes, as we'll discuss later, comes from LCHs. In terms of, we think this is a really important topic to be working on. Well, first of all, you're well aware that centralized clearing has really taken off since the financial crisis and since the G20 commitment to take standardized OTC traded derivatives and clear them centrally. And this gives rise to reasonable and plausible questions as to what's the optimal shape and structure of the clearing arrangements that we're going to have in place. Should there be one CCP, few CCPs, many CCPs? What's the impact in each case on the netting benefits? What's the impact on collateral demand? And despite these theoretical questions, in practice, we do see that multiple CCPs exist in various jurisdictions, and oftentimes these CCPs clear similar or exactly the same types of contracts. And I have here some examples of such CCPs. And the question is then, is it costly? Is this optimal? Is this something that regulators should encourage? Is this something regulators should avoid, etc.? And economically speaking, these are important questions because we've reached the point now where clearinghouses process the vast majority of interest rate derivatives and almost half of credit derivatives. And the numbers, especially for interest rate derivatives, are large, right? According to the BIS, the outstanding notional amounts in the interest rate derivative space as of last year was in the order of $450 trillion. So we're talking about major markets which are largely being centrally cleared. So this question is extremely relevant as to what the structure of clearinghouses ought to be. Furthermore, and I would say even more intriguingly, what we've observed is that these bases or price differentials have popped up. And I have here two examples. One is for the 5-year dollar interest rate swap contract that's being cleared in CME and LCHs. And you can see here how the basis fluctuates over time. And another one for the 10-year euro-denominated plain vanilla swap contract, which is being cleared in LCH and Eurex. So these are extremely interesting phenomena because, for people who are doing finance, these are deviations from the law of one price, right? You have the exact same product, the exact same contract, effectively trading at different prices in different jurisdictions. And more importantly, right, given the magnitude of these markets, this is surprising, right? These are major financial markets. So why is it that these bases arise, right? This is another question that presumably, potentially is related to the way that these contracts are cleared. And of course, as with anything related to the UK these days, Brexit is also relevant in this discussion, not the least because of what's been prescribed by EMIR, the European Market Infrastructure Regulation, which basically prohibits clearing members that are domiciled in the EU from accessing services, clearing services of CCPs that the EU deems that are systemically important and which are located outside the European Union. Up until Brexit, LCHs, this is clearly, this mainly affects LCH, which is one of the largest CCPs in the world. Up until Brexit, LCH was the UK was part of the EU, and Brexit and LCH was within an EU jurisdiction, so that problem didn't arise. And But now, according to European regulation, there's a bottleneck. So the rules require that for participants to access these services actually have to relocate to any EU jurisdiction. And if that were to happen, following the European regulation, that would constitute a substantial fragmentation in the clearing landscape, a further fragmentation in the clearing landscape. Just to give you also two recent pieces of updates on precisely this issue, these are two articles from the Financial Times as of September of this year. One says that in order to avoid a disruption in financial markets, EU authorities have granted participants in the EU have granted them access or allowed them to access London clearing houses for an interim period that's going to end in the mid of 2022. But the general idea and the general understanding is that EU participants should use this period to try and reduce their exposures to UK infrastructures. And also, there's this other piece of news that EU regulators are now going to classify clearing houses that reside outside of the European Union, and they're going to give them a classification based on how systemically important they are. And again, chances are LCH, which is the major clearing house in the UK, is going to be vetted. Chances are it's going to be classified as a tier 2 CCP, i.e. systemically important CCP, in which case all of the above rules and restrictions that we mentioned are going to kick in after this interim period expires. So I guess the bottom line here, what I want to say is that this is a live policy issue, and it's highly relevant in this respect. So let me just a little bit summarize the key intuition of the paper, and also say in this slide why, what happens. As we just described already, you have trading happening on a global scale. You have dealers providing liquidity in multiple jurisdictions. And alongside that, you have a fragmented clearing landscape. Because the clearing landscape is fragmented, dealers cannot fully offset these exposures within a given CCP, and this raises their collateral costs. And now, to connect that to the price distortions and the basis that we just mentioned, what happens is that, and this is essentially the point that the paper is making, is that to recoup these collateral costs, right, the dealers are going to set a higher price where clients are mostly buying, in other words, in the jurisdiction where they're faced with buy flow, and they're going to essentially set a lower price at the jurisdiction where they're faced with sell flow. In other words, dealers are recouping these collateral costs, and they're recouping these costs in the old-fashioned way, which is buy low and sell high. And this is what gives rise to these CCP bases. So that's the intuition of the paper. Now, this is a very, very small subset of the related literature that this paper touches upon. I would just very quickly say, I'm not going to go through these papers per se, but I'm just going to say that what we're doing is related to a substantial body of work that has studied different netting configurations and the associated collateral requirements. It's related also to the impact of regulation on price and the effect that regulation has had on various market prices, which operate via dealer balance sheets. And here we have a number of different recent papers that have studied different types of deviations and price distortions as a result of dealers being balance sheet constrained. And of course, it relates to the classic literature of inventory management. So at this point, having essentially presented the key ideas and what the paper is about, I'm going to pause and take any questions that people might have.
Thanks a lot, Evangelos. We have a number of questions. I was thinking about, I realized that fragmentation of clearing emerges when we have several different jurisdictions that trade where the same asset is traded. I was wondering if there are, if it can be an equilibrium outcome that we get fragmentation of clearing within the same jurisdiction. And the first question here by Ethan Owner maybe relates to that, because his question is, when thinking about CCP fragmentation, are you also thinking about the widely voiced criticism of CCPs being too big to fail? So one CCP to clear all would be heavily subject to such a criticism.
Yes, so thank you very much for Honor for this question. With respect to the existence of multiple CCPs within a given jurisdiction, I think the same effects carry on. What drives these effects is not the fact as much that the CCPs reside in different jurisdictions, but that there are different CCPs clearing the same products and therefore request collateral on a standalone basis. So even if these CCPs were located in the same jurisdiction, dealers would still have to pledge collateral to different CCPs. Of course, then the question becomes, why would you have two CCPs in one jurisdiction offering the exact same, clearing the exact same products? So it's not something that we, as far as I understand, we observe at this point. We do have multiple CCPs in jurisdictions, but these tend to clear different products. There is a little bit of overlap sometimes, but the amount of overlap is not very big. It's absolutely true that that if you were to concentrate everything in one CCP, you would run into all kinds of other issues. So this is you know, I'll be very honest about this, that this is something that we abstract away from. You know, we're not talking about we're talking about the costs of fragmentation, not the benefits, in other words. But and you know, one of the things that immediately comes to mind is, even if CCPs were too big to fail, and you just had one CCP, the question is, you know, who would bail them out if you had to, right? Would it be the authority in which the jurisdiction in which they reside, or would it be someone else? So, absolutely, there are multiple issues and dimensions at play. You know, one could argue that you know, if you fragment clearing and therefore you have more collateral being pledged as a result to collateralize the exposures that are generated, well, that's good for financial stability, right? Because there's more collateral for a given amount and size of exposures. So, you know, it's definitely true. One could argue either way, and as we'll see, as I'll basically allude to later on, there are also business interests associated with clearing fragmentation. It's good to have a clearing house in your jurisdiction, right? So there's a clear incentive, for example, by EU authorities and governments as to why they would like some clearing activity to migrate over to the EU. So these are all very fair points. The one thing I'm going to mention is that in terms of you know, what we're doing here is that we're just looking at you know, what the cost is associated with collateral, because this is a major source of clearing costs in, you know, for CCPs and participants who clear via the CCPs.
Thank you very much. Now, Albert just chipped in an answer here to Pankaj's question, but I think I'll post it to you anyway. Are there potential institutions that can serve as an international CCP? Institutions that clear international payments, maybe with blockchain solutions? And Hans de Groys has a related question about if there is a way for to do interoperability between CCPs that may be able to undo this cost that you describe.
So I think on the issue of blockchain, I think there are some fintechs out there. There are some startups who are at least trying to roll out applications, fintech applications, to facilitate, for example, settlement. But by settlement, especially in securities markets, but it's definitely the case that centralized clearing, or at least clearing, could also, in principle, be, you know, if you do settlement, you can most likely do clearing as well. Now, I'm not an IT expert, so I don't want to say things that I'm not entirely sure about. So it looks as if some people believe that it's technically feasible. I'm not sure about what the legal and institutional implications around that might be, who would be in charge, how it would be organized. And maybe related to the question on interoperability, I think there is a live policy, or at least there has been a live policy discussion on interoperability for a number of years. But as far as I know, this has not advanced as much. So things have not changed in this respect. They have not, they have not progressed in this respect quite a lot. So at this point, we're still stuck with a landscape with a clearing landscape that's fragmented and which is also about to get even more fragmented.
Great. Let's continue.
Okay. Well, thank you very much. So what we do next is we take this simple logic behind clearing fragmentation. We just have a simple model to rationalize our thinking. And I have to say that this model is a very simple extension of a model that's one can find and read in the excellent book by Foucault and co-authors, Market Liquidity. So we take one of their inventory models and slightly extend it to basically make it fit our purpose. So what happens in the model is that we have a contract, think of it as an interest rate swap that has fundamental value and which is cleared into different CCPs in two different jurisdictions. And this contract is traded at a price, a time T, which is unique to its clearinghouse. And there's also a bid and ask spread associated with trading of this contract in its jurisdiction. And of course, given the bid and ask prices of this contract, we also have a mid-quote. So that's the asset that gets traded. Now, in terms of the players that we have some liquidity traders. You can think of them as dealers' clients. These are the participants, the market participants who consume liquidity or who go to the dealers to obtain liquidity. And there are two kinds of them. There are two kinds of liquidity traders. There's a percentage delta of those liquidity traders who are price sensitive. And by price sensitive, we mean that they can choose where to clear, first of all. In other words, they can access both jurisdictions and both CCPs. But second of all, they respond to prices in the sense that if they observe that in a given jurisdiction, the mid-quote is below the fundamental value of the contract, they will buy the contract in that jurisdiction and they will sell in the opposite case. If the mid-quote equals the fundamental price, they will abstain from trading. But the important thing about these price-sensitive or sophisticated, as we call them, liquidity traders, is that they can choose, again, where they want to clear. Think of those guys as relatively, as some banks who are not themselves dealers, who are large enough to have presence in multiple jurisdictions and who have the ability to book their trades in either clearinghouse, or it could be some very large asset manager or some very large hedge fund. Next to these price-sensitive, sophisticated investors, we're going to have, the remaining of our investors are going to be the smaller ones who are price-insensitive. They're always going to trade. They extract utility from trading, from simply being present in this market. They have to be present in this market, and which cannot decide where to clear. So they're basically stuck in a given jurisdiction. And the interesting thing about them is that in each jurisdiction, A or B, a fraction pi of them are going to be buyers, and the opposite fraction, one minus pi, are going to be sellers. So what we're trying to model here is the fact that you have end users in different jurisdictions, which as a result of the business model that they follow, they have to be directional traders. And this is actually what is really driving these CCP bases, as you will see later on. Think, for example, in the case of CME in Chicago and LCH in London, for example, we see that flows in swap contracts in the United States from clients are predominantly buy flow. So the net flow is a buy flow. And the opposite is true in LCH in London. And there are various reasons why this could be the case. But this is what we're trying to capture with this, with these types of participants, liquidity traders. So these are the liquidity demanders, and then we have, and as a result of, let me just say that you have the delta, the sophisticated guys, you have the, the price insensitive, less sophisticated participants, and the two of them give rise to these order flows in each jurisdiction and in its price configuration that you can observe in its CCP. So for example, if you look at the first line here, this is a situation where the fundamental value of the contract is less than the prevailing mid-quotes in either CCPA or CCPB. And what happens is that the prevailing mid-quote in CCPB is larger than the prevailing quote in CCPA. So the unsophisticated folks are going to just do the delta and minus delta no matter what the price configuration is. But the sophisticated, the flexible investors, they're going to sell first of all, right? Because the mid quotes are higher than the fundamental value. And where are they going to sell? They're going to go to CCPB to sell in jurisdiction B because the price there is higher. So you have this minus delta over here, which is the sell flow from these smart investors. And you can do the same, the same calculation for all these different types of price configurations. So these are the liquidity takers. Now we have the liquidity provider, who's a dealer. We're assuming that the dealer is competitive, is risk neutral, chooses the contracts, the number of contracts that the dealer wishes to trade. This is the inventory law of motion, and also the dealer bears a collateral cost. And that you could think about this as you could think about this as the cost, for example, the funding cost that the dealer has to bear in order to pledge this collateral, or you could think about this as some kind of funding value adjustment that cost that the dealer bears. So the overall cost of the dealer, who is, by the way, active in both jurisdictions and provides liquidity in both jurisdictions, is going to be the sum of the collateral costs in each jurisdiction. And observe here that because no netting is possible across CCPs, right, the overall collateral cost is going to be just the sum of these two collateral costs. In other words, the inventory and the exposure in CCPA cannot be netted with the inventory and exposure in CCPB. So they have to be added. And this is what really is going to drive a dealer's behavior going forward. So the dealer is risk neutral, and is also short-sighted to keep things simple. So the dealer just optimizes over next period's wealth. Next period's wealth is just simply the mark-to-market values of the positions that the dealer maintains in its clearinghouse minus the total collateral cost, which is this bit here. Markets have to clear, client flow has to match what the dealers supply. And in this setup, what you can do is what Foucault and Pagano and Royal do in the book is they conjecture this linear relationship between quoted prices and inventories, which is consistent with dealers optimizing conditions. And basically what this relationship tells you is that the prices, the quoted prices, are going to be a function of the fundamental value of the contract plus some adjustment that takes into account the dealer's inventory. So if the dealer, after having traded a quantity QT of contracts, ends up with a positive inventory, right? The price, the quoted price, is going to be adjusted downward relative to the mid quote. So that's consistent, right, with the dealer's objective, who's trying to minimize the collateral costs. And why is it consistent? Well, it's because if the prices, the quoted prices, go down, right, then clients, liquidity traders, are going to buy more from the dealer, so that the overall inventory cost of the dealer is going to go down. So this gives rise, this tells you what the mid quote is in this setup, what the ask price is and what the bid price is. So, and if you combine therefore the dealer's funding or first order conditions with this conjecture, you get an expression for the equilibrium quoted prices. Essentially, you get you get an expression for this beta in terms of the parameters that we have already introduced, which is phi, the unit collateral cost, sigma, which is the volatility of the underlying asset, delta, the fraction of smart investors, and pi, the structural order imbalance among the less sophisticated investors. this gives you an expression for the mid quotes in its clearing house, and that immediately gives you an expression for the CCP basis, because you only need to take the difference between the mid quotes prevailing in its jurisdiction, and all of a sudden you have an analytical expression for the CCP basis. What is really nice about this expression is that it immediately gives rise to testable hypotheses. So for example, what it tells you is that the CCP basis, and if this theory about dealers trying to compensate themselves for this collateral cost is correct, the basis is going to be a direct function of the inventory imbalance across CCPs that the dealers have, times the volatility and the riskiness of this imbalance. Bear in mind that most clearing houses, when they calculate the collateral requirements of their participants, they employ typically standard value at risk methodologies. And in those value at risk methodologies, the collateral cost, the required collateral, is a direct function of the volatility of the underlying portfolio times the size of the portfolio. So this is essentially telling you that it's the amount of collateral that the dealers have to pledge with clearing houses overall that's going to determine the size of the CCP basis. This size is also going to be determined by the percentage of delta, how many flexible investors you have. If you have a lot of flexible investors, they're going to go where prices are keener, are better, and they're going to reduce the dealer's inventory imbalances and therefore their collateral costs. So this delta should be negatively associated with the CCP basis. The basis is also a function of the unit collateral cost. And as I said earlier, one way to think of this unit collateral cost is to think of what it costs the dealers to go into the funding markets in order to obtain this collateral and subsequently pledge it with the CCP. But another way that we like to think about this collateral cost is to think it in terms of debt overhang. And I'll explain in a minute exactly how that interpretation of the unit collateral cost works. Another thing is that another hypothesis you can extract from this model is that all of these effects, this basis is going to be larger and more pronounced for longer term contracts, all else being equal. Why is that? Well, it's because longer term contracts typically have more risk, are riskier, and therefore, the collateral that CCPs will demand for these exposures is going to be higher. So this is, the sigma for these longer term contracts is going to be higher. And finally, one last thing is that if to the extent that you have clients, volume by volume in LCH, which is the opposite of what the structural imbalance is at the moment, then you would have a reduction in the CCP basis. So overall, this is a very convenient formula because it's so rich in terms of the various testable hypotheses that it generates. Let me just mention one thing about this debt overhang idea, and then I think we have questions. So here's the idea behind that. You have a dealer, right, who has a balance sheet, and that dealer now is faced with increased collateral costs. So the dealer needs to go to the funding markets and obtain new funding in order to pledge new IM, initial margin, with the clearing houses. One of the effects that this has, and this is something that's been has been very well articulated recently by Darrell Duffy and his paper on funding valuation adjustments, is that as a result of this operation, the new funding that the dealer is going to raise to meet this new obligation is going necessarily to be junior to the existing debt that resides on dealers' balance sheets, right? So it could be equity, it could be new equity, or it could be junior debt. In any case, what that's going to mean is that the buffer that protects the claims of senior debt holders is going to grow larger. You have new high-quality assets being added to the balance sheet, and you have new junior liabilities being added on the liability side. So the debt of senior debt holders becomes the value of the debt of senior debt holders becomes safer, and therefore increases. And so what that implies is that you have this value transfer from equity holders, right, to senior creditors. Now, this is something that equity holders of these institutions don't particularly like. So to the extent that this operation reduces their net worth and the value of their equity, they will want to be compensated for that. So this is another way of queuing this and of interpreting this unit cost of collateral. And as we'll show in the last part of our presentation, there's empirical evidence in support of that logic. So I'll pause here once again and take any additional questions that people might have.
Yeah, thanks, Evangelos. There are currently no questions, and I'm keen on seeing the empirical evidence. And so okay. I suggest we move on right away.
Very good. Okay. So straight on. So as I said at the beginning, by the way, I'm sorry, Björn, just a quick question. May I ask how much time do I still have?
Yes. It is 5 minutes left, and
5 minutes. Okay, now, I have to rush.
I got a question from Pete Kyle, but maybe we take it then after. So I give you these 5 minutes to talk about the empirics, and then we'll let Pete come in in voice later. Okay. Okay. Yes. And apologies. I may go a couple of minutes, but okay. I'll try to finish in time. So sure, no problem. So as I said earlier, we take this model to the data, and we're very fortunate to have unique data, supervisory data, which consists of the actual amounts of collateral pledged by dealers in LCHs. And also for LCHs, and in particular their swap clear service, we have information on the actual trades that are cleared. And this involves trades in all contracts that are part of the same netting set within swap clear. That would include IRS contracts, forward rate agreements, OIS contracts, etc. And the fact that we can see who is trading with whom allows us to classify the participants in these markets as dealers or clients. So this is the key part of the data. I'm going to speed up a little bit because I want to get to the main points. The other thing we do is we take from the two clearing houses, CME and LCH, their yield curves that they use to price their contracts, and then we just recalculate from scratch the CCP basis. We reconstruct the CCP basis by using the standard interest rate swap pricing formula. So we use the yield curve for CME to extract the fixed rate of CME contracts, and in particular dollar-denominated interest rate swaps for various maturities, and we do the same thing for LCHs. And by doing that, we reconstruct the CCP basis for various maturities for dollar-denominated interest rate swaps. I want to be clear on that. The basis that we observe is on dollar-denominated swap contracts, and that's because it's the dollar contracts that are equally split in terms of their clearing, but almost equally split between CME and LCHs. So once you do this calculation, you end up with this figure, which is the average basis across contract maturities over time. Our period is from 2014 to 2016. One point I want to make here is that this is economically significant. If you were to do a back of the envelope calculation about what it might cost sellers of interest rate swap contracts in LCHs, what the opportunity cost of these sell trades be, then you would end up with a figure of about $80 million on a daily basis. Because again, this figure shows you that the prices for interest rate swap contracts, dollar swap contracts, is higher in CME than in LCHs, right? Remember, the basis is the price of CME minus the price in LCHs. So this is positive, which means that whoever is receiving a fixed rate in LCHs, in other words, whoever is a seller in LCHs, bears an opportunity cost. And the overall opportunity cost of these trades, if you were to do this back of the envelope calculation, which I'm not going to explain now, I don't have the time, is a quite substantial amount. So we take the data that we have to our model, and we take it to our testable hypothesis. These are the model parameters that we have in the CCP basis formula, and these are the variables that we construct in order to proxy for these parameters using the data that we have. And let me take you straight to some of the results. So this is a simple time series regression where the basis is on the left-hand side, right? This is the average basis across maturities. And this is regressed on the amount of collateral being pledged, or proxies for the amount of collateral, the flexible ratio, which is a proxy for the variable delta that we have in our model, and the LIBOR spread, which proxies for the
for the funding cost associated with pledging collateral. And you can see that all the variables are extremely significant in the direction that you would expect them to be. Let me just say that in terms of proxying for collateral, we have three different variables. We have the actual IM that's being pledged by dealers who are active. These are the dealers who are active in LCHs. We have the absolute cumulative net volume of these dealers. This is a less accurate proxy for overall funding costs because it does not capture the riskiness of these positions. And also, it's not a very good proxy either for the actual outstanding exposure at any given point in time. And also, we use the changes in the expected funds rates as a proxy for the inventory imbalance that dealers might have in Chicago, in the United States. And that's because if you expect the Fed funds rate to increase, then a participant in the swap market is going to basically want to lock into the existing rates, right, thereby exacerbating the buy-order imbalance in that jurisdiction. So no matter what variable you use, you see that the effects are coming out pretty strongly, supporting the key idea of the model. We kind of do now repeat the same specification, with the only difference being that the dependent variable has changed, and instead of the average basis across maturities, we take the difference of the basis between high maturity and long maturity and short maturity contracts. Because remember, one of the other testable hypothesis was that these effects are going to be more pronounced for longer maturity contracts. So we kind of construct this basis differential and essentially condition it on the same variables, and the effects remain the same, suggesting that these effects are more pronounced for longer maturities. I'm not going to discuss this because I don't have as much time, but this, essentially what we do here is we kind of repeat these experiments in a dynamic setting, in a VAR setting. And let me go to the final table of the paper, which is a panel regression. So this table essentially looks at the cross-section of dealers active in LCHs over time. And essentially, we do the same calculations as before. The only difference here being is that we constructed dealer-specific basis. And we have a dealer-specific, we have the amount of collateral that individual dealers pledge. We have a proxy for our delta parameter, and then proxies for dealer credit risk. And this dealer credit risk can be either the CDS spread of the dealer or the equity ratio of that dealer. And two things before I finish. So you can first of all see that this idea of debt overhang is very strongly supported in the data. A higher CDS spread suggests, predicts a higher dealer basis, and equally a higher equity ratio, which means the dealer is less at risk, predicts a lower basis. Remember, this debt overhang hypothesis and the effect is going to be more pronounced for dealers, right, that are more at risk, for dealers whose senior creditors, right, are more at risk. Because when you create this buffer by juniorizing new liabilities, then it's those dealers, it's those creditors who are more at risk who are going to benefit the more. And therefore, it's in those cases where you're going to have a very higher transfer of value from senior creditors, from shareholders, to senior creditors. And the effect, therefore, is going to be stronger. Last thing to mention about this table, and which I should have probably said earlier, is that the way we proxy for this flexible ratio, right? Remember, this captures this delta parameter, which is the fraction of flexible investors in the system. With the way we capture this is the percentage of volume in the markets that LCH clears that are accounted for by non-dealer banks. So we have a universe of participants, and we take those banks that are not dealers and take their proportion of trading volume. And this is our estimate of this delta. The reason why we do this is because in the vast majority, these institutions have operations in multiple jurisdictions. They're not dealers themselves, right? So they're price takers in these markets, but nevertheless, they have presence in multiple jurisdictions, which means they in principle have the ability to book these trades wherever they want. They can flexibly choose the location. And as you can see, and as predicted by the model and confirmed in the data, the amount of the percentage of trading by these entities is negatively and significantly correlated with the dealer basis. So to conclude, this is the final slide. We've tried to understand the economics of a fragmented clearing landscape. It's pretty clear that this increases collateral costs. What is less clear, and we hope to have persuaded you about is that this can lead to price distortions. Now, these price distortions are economically significant, right? And this is something we have not examined in this paper, but it's very likely that because of their economic significance, they have substantial negative welfare effects. The other point to take home is that as a result of multilateral netting and the mechanics around multilateral netting, CCPs are good examples or prime examples of natural monopolies, right? Because they're characterized by large economies of scale. And this discussion is very relevant given the current circumstances and ongoing developments around Brexit. So with that, I'd like to thank you very much for the opportunity to present this to you, and I'm open for any further questions that people might have.
Thank you very much. Pete, Kyle had a question, and Wenqian has now answered it in the chat. Pete, do you still?
Let me just say that I cannot see the chat box, so I don't know exactly which questions are.
Yeah, that's fine. Okay.
Yeah, so that wasn't exactly an answer to my question. So, Evangelos, thank you for an interesting paper.
Thank you.
So my question was, your model doesn't seem to have in it what types of collateral the exchanges require for posting. So currently they probably require government securities. Government securities have very low interest rates, but they could presumably change and let you post other types of collateral. You could post commercial paper, you could post AAA bonds, AA bonds, investment grade bonds. There are a whole bunch of different possibilities. And it seems to me that what they allow you to post or require you to post might affect this the model of kind of credit constraints where the firm needs to kind of get some extra capital to post the collateral, because it wouldn't cost the firm anything if they could post as collateral whatever positions they held in their arbitrage portfolio anyway.
Well, thank you very much, Pete, for this question. So my understanding of the types of collateral at the moment, at least that CCPs accept, is they roughly accept, I think, 50% cash, and that 50% is not something that's prescribed. It's just what the evidence shows. It's so roughly the amount of the type of collateral pledged is more or less cash and very high quality government loans. So at this point, I don't think, and maybe Wenqian can correct me because he's closer to the policy debate around CCPs. I don't think that lower ranked or bonds with less credit quality are acceptable, and that's largely because regulators basically tell CCPs what to accept. But I think you're right. I think that if the collateral basket were to be expanded, then there would definitely be implications, especially if you might see a reduction in the CCP base. Well, it's not clear, because the thing is, if one were to pledge less, if one were to pledge collateral of lower quality with a CCP, what the CCP would do would be to increase the haircuts, right? Because the CCP, ultimately needs a certain amount of guarantee from whatever collateral is being pledged. So it's not clear. So you basically need more of less of lower quality collateral to meet that demand. The question then is whether that would affect the basis or not would depend on whether, from the dealer's point of view, generating and raising a larger amount of lower quality collateral would be less or more costly than raising a smaller amount of higher quality collateral. So I'm not sure what the answer to that is. Maybe there's a clear answer, but I can't think of it right now. But bear in mind that the CCPs are always going to be there, and they're going to be charging haircuts. They even charge haircuts on cash collateral. If you happen to have a position denominated in euros and you pledge collateral denominated in dollars, they're going to charge a haircut even for that, even if you pledge US dollars to cover this euro exposure. I don't think I've answered well this question, but this is the best I can do. I'm sorry.
Thank you.
Okay, so anyone who has a question is welcome to use the raise hand function, and I'll let you in. there are currently no questions lined up. So let me ask a question. Your model leads to this nice expression for the basis, and I was trying to think about if there are circumstances when this basis can grow very large, in that sense, become a threat to financial stability. There were many parameters in there. So what is there any of those you think would be the key suspect if we get a very large basis?
So I think this is a very good question, Björn, because it allows me to say the following. The key driver of the CCP basis is the inventory imbalance that dealers face in each jurisdiction. And this inventory imbalance can change. It so happens for the case of Chicago and London that because of some structural imbalance that exists because of the liquidity traders in those markets, this has happened to be positive and unidirectional for a number of years. But if, for example, US clients or US market participants were to decide that they want to sell swap contracts, this could go to zero or it could become negative, right? So the CCP basis could easily flip. But overall, what the key driver of the CCP basis, I think, are going to be the flows. I think the thing that changes the most over time are precisely these flows by dealers' clients. Now, of course, the other parameters could change, but I think they are less likely to change frequently because the number, for example, or the kind of participants who can trade flexibly might change, a little bit over time, but not that much. You're not going to have a major shift in who can clear locally versus who can clear flexibly across borders. There was a case, however, of something that maybe we should mention in the paper of some participants, market participants in Japan, who were constrained by their local authorities in clearing domestically. And at some point, this requirement was lifted. This is a point, again, that Darrell Duffy has made at some point in the past. And what you saw as a result of that, of this regulatory change, was that the basis that prevails in yen contracts being cleared between London, if I remember correctly, and Tokyo, there's a basis there as well that substantially decreased as a result of that. Because essentially what happened was that this delta parameter went up in that case. So the delta parameter could be either a result of there not being as many sophisticated participants who can trade internationally, or it could be the result of some regulatory constraints and restrictions.
Thanks a lot. So we have Peter Lerner has a question.
I wanted to contribute to this answer. Foucault model of 2013, on which this treatment is based, has some limitations or natural limitations on the values of the parameters. And it destabilizes internally if, for instance, 2 pi is too close to 1. Technically, Björn, I think, is right, but the validity of this model will be under serious question if there will be values of the parameters increasing the basis to infinity, for instance.
Yes, yes. Thank you very much, Peter, for that comment. Yes, I think you're exactly right. And maybe the way we presented the model, we were not very clear about what restrictions we're assuming for the various parameters. One restriction is that, for example, that delta cannot be equal to 1 in our model. So we cannot have everybody essentially being a smart investor, because then the basis would disappear. And the model effectively does not nicely account for that, because if you set delta equal to 1, the basis does not completely disappear. So you kind of need to impose some kind of parameter restrictions in order to make the model relevant for what we are discussing here. So that's exactly right. What Peter said is exactly right. I just also want to say that because, Björn, you mentioned at some point whether that might create financial stability risks. I don't really think that this is an issue of really financial stability concern. It's essentially an issue of, having basically economies of scale in the ideal scenario, and then essentially breaking your netting sets and essentially ignoring these economies of scale and failing to realize these economies of scale. And when you do that, essentially what happens is that end users end up paying a cost, right? It's actually interesting to see who bears the cost, because if prices for fixed rate, for interest rate swap contracts are higher in Chicago and lower in London, the people who are paying fixed in these contracts are paying the price in Chicago. The people who are receiving fixed in London are bearing this cost. But the ones who have the opposite trades in these jurisdictions actually benefit. If you're someone who is receiving fixed in Chicago, you're benefiting from that. So the interesting thing about this phenomenon is that those people who bear the costs, the buyers in Chicago and the sellers in London, not only need to compensate the dealers for their collateral costs, but also need to compensate the profits that accrue to those who have the opposite positions in the exact same jurisdictions. So that's why we mentioned at the very end that there's a lot of wealth, there's a good amount of wealth being transferred here as a result of this CCP basis. And we think the key cost is basically a welfare cost. We kind of think of it as some kind of welfare cost associated with some form of taxation, for example.
Interesting. So Evangelos has promised to stay on, so please raise your hand if you have a question. We're reaching the full hour now, though, so let me take this opportunity to announce the next seminar that will be in 2 weeks from now on December 15th by Carol Comerton-Ford, and that will be the last one for this year. So are there any remaining questions now for Evangelos? It's the downside of having Albert as a co-author. He normally always asks for
Right.
2 or 3 questions. Well, then thanks a lot, Evangelos. I think this was super interesting.
Okay.
And thank
Well,
you
thank you very
everyone
much.
for coming, and see you in 2 weeks.
Thank you very much for your attention and for having us on. Thank you.